Hello and welcome to the Market Programme. I'm Matthew Vincent, editor of Investors Chronicle, and today I'm going to be talking about riba. Now at this point some of you are probably thinking, oh no, he's going to bang on about the Royal Institute of British Architects and the latest gherkin or carbuncle they're building in the city. But no, I'm not talking about that at all, because others of you will realise that riba is actually the word for interest in Sharia finance. And as such, riba is something to be avoided, because under Sharia principles, it's a definite no-no. So you might think then that for the global banking system, trying to meet with Islamic principles is something of a tall order. After all, banks exist and live and breathe, if you like, to earn lots of interest out of all of us. But there is one bank in particular that's become the world's leading provider of Sharia products and services. It's here in the UK, it's our very own HSBC. So I've come here to Canary Wharf to talk to Hussam Sultan about how they've done it. So Hussam, what exactly is a Sharia compliant product?
Well, like any other product, it is important to note at the beginning that these are financial products and not religious products. So by knowing that, these are just normal financial products that happen to be designed and structured in a way that observes the parameters of the Sharia law, which is the Islamic law. Having said that, there are a few parameters that are prohibited in Sharia. For example, charging interest on a loan, or actually incurring interest out of loan-based transaction. There are other parameters that have to be observed in these type of financial products. For example, the sharing of profit and loss, the sharing of risk between all parties involved in this type of products. Sharia emphasizes that there has to be an element of risk taken by all parties involved. For example, if I give you a loan of £1,000, I should share with you that the risk of that loan. If I give it to you to go into a business together, for example, then I shouldn't give it to you expecting that I will have that money back with any profit, regardless of how that business venture does. So I should share some of the loss with you. You do the business, I'll give you the loan. If the business collapses, then I should share some of the loss with you. In addition to other ethical parameters, for example, investing in certain industries that are deemed to be prohibited or unethical. These are all parameters that have to be taken into account when you structure a financial product that is Sharia compliant.
It's a very good example, that business loan. But what about savings and investments? How do they work?
Well, on the same basis, I mean, you can still generate income for these type of accounts. For example, having a savings account, you can still deposit your money in a normal savings account in a normal retail bank and expect an income back from that money. However, how you generate that income is what makes the difference between a Sharia compliant product and a non-Sharia conventional product. In a Sharia compliant product, these returns are labeled as profit and not interest. So when you give the bank your money, you're not giving it as a loan to the bank, but you're giving it as an investment. So the bank will invest that money in a Sharia compliant investment and will share some of that profit with you.
So how do the returns on Sharia compliant products compare with the interest rates on other products?
Not very far. I mean, at the moment we use the interest rates as a benchmark to price our products and services, because you have to operate from within the market. You can't be deemed as very expensive or very cheap, or it has to be comparable to the rest of the market. So it's not very far from the conventional interest rate products. We use interest rates sometimes in some of the products as a benchmark to price our products. Some of the products are sometimes described as maybe relatively more expensive, but they're not. I mean, there is an element of cost added to these products. However, we believe that the more players come into the market, the economies of scale will be achieved, and then these products will eventually be very competitive in price.
You're now a leading provider of these products, but where have you seen all the growth coming from?
Well, the growth is coming from Middle East and Far East. If I give you an example, like in 1975 there was only one Islamic financial institution. Now there's over 300 of them. Major banks in countries like Saudi Arabia and Kuwait and United Arab Emirates have transformed all their operations into Sharia compliant. It is estimated that between 8 and 10 years, half of the savings of the world's Muslim population, that's 1.6 billion, will be in Sharia compliant manner. Muslims are now learning more about it, and funny enough, even non-Muslims are learning more about it, and some of them have even taken these products. As I said before, these are financial products, they're not religious products. You don't have to be a Muslim to take a financial product that is Sharia compliant, as in the same way you don't have to be a Muslim to eat a halal curry.
So there's an opportunity for Muslims and non-Muslims to invest in the actual products. Are there also investment opportunities in the companies providing these products?
Absolutely, there's a huge investment opportunity there, and indeed we see quite a lot of because of this transformation and the phenomenal growth worldwide, a lot of global players are seeking opportunities, investment opportunities in these banks. And this is probably, you would know better than me, looking into the news bulletins and the economic bulletins, you will see that transformation happening and that interest. I think it will be very silly to ignore the growth of this sector of the financial markets at this moment in time.
Well, I can see lots of growth opportunities. I can also see great lending products. I like the idea of a loan where you share the risk. So thank you very much indeed for talking us through all of those.
You're welcome.
Finally today, it's that part of the programme where I tell you what's been getting on my nerves. And this week, it's stupid and ill-thought-out regulation that make it impossible for private investors and financial journalists to get any idea of the value of important sectors of the UK stock market. Now, before I burst a blood vessel in my head or my tick gets any worse, I should point out that I'm not talking about the US Senate and its bill to make it illegal to offer online gaming services in the US. That self-interested, protectionist bit of legislation, which is basically just to benefit US companies, is something that I have said has got on my nerves twice already in the market programme, and we cover it in great detail on the Investors Chronicle website this week. No, instead, I'm talking about some UK regulations that govern AIM companies. Now, this week they got a lot of plaudits on AIM because they've improved some of the nominated advisor regulations. But I'm talking about the regulation which says any company that has a financial year end on the 30th of June has until the 30th of September to issue its results. What happens? They all wait until the last minute. So last Friday, the 29th of September, 142 companies all issued their results at the same time, making it almost impossible for us to cover the companies and making it even more difficult for you to work out what the correct share prices for them should be. It's like bus deregulation. You wait and you wait and you wait and 142 come along at the same time. It's daft. Why can't we just stagger them for all of our benefits? Now, if you've got any views on that or anything else in today's programme, please do drop me a line at the email address appearing on the screen right now. Contact me and let me feel your pain. But until next week, whether you're in the market or out of the market, stay online for the market programme.